For step 1, meeting investment prerequisite. On this step, we were about to know if our client life condition will meet the expected requirements to acquire for an investment. So here, let's take a look at his profile. Mr. Kalma Hector is 31 years old, single, and has a stable job being branch account and junior assistant manager. At his age, he's planning to have an investment. According to him, his lifestyle and his financial condition can afford to have an investment. Let's see what his financial goals are. First is diversification of assets with different investments. According to our client risk tolerance, he is a moderate type of investor, so it is better to put his investments in stocks, bonds, and real estate. Second goal is to maximize return both on short and long-term investment. Moderate investor like Mr. Kalma Hector wants to achieve good returns for more than 5 years. Next goal is to ensure capital growth of investment value. Since Mr. Kalma wants to diversify his investments, this reduces the risk and ensure that over time, each of his investment will increase its value. Next goal is earning a return and meet future needs from capital appreciation. Over time, the value of his investments may increase depends on the status of the market. Having the right people to guide him, he can achieve his expected return from these investments, especially one of them is real estate. The good thing is the value of the property do increase and also the rental income. Lastly is long-term growth and capital preservation. With the proper diversification of Mr. Kalma's investment, it can preserve capital and prevent loss in his portfolio and achieve the long-term growth of his investments.
For the investment plan of Mr. Hector, for time horizon, the client chose to invest for medium and long-term investment as a moderate investor. The client's major expenditure is house and lot. He plans to achieve this goal in the span of 5 years starting this year. In terms of liquidity, it is the ability to convert an asset into cash easily and without losing money against the market price. Investments that can be easily bought or sold are said to be liquid. For the client, it is important for him to have an investment that can be liquidated to cover up his unexpected need for cash. With a total amount of 32,000 to 63,000 pesos, the client can already cover up his 3 to 6 months of expenses. For the retirement fund, he plans to retire at the age of 60. His retirement fund goal is 3,142,500. This was calculated by using the 25 times rule, which will multiply his annual spending of 125,700 in 25. For his asset allocation, investment includes 65% on stocks, 30% for bonds, and 5% on real estates. For the detailed allocation, it will be discussed later on. Let's go with the investment vehicle. For him to assess his risk and return, the client is willing to sell a portion of the remaining investment in case some part of it fell more than 20% in just a few weeks. The client is considering the expected return as basis of whether to remain or to give up the investment. The return goal of the client is 7%. Here is a sample scenario for a specific investment. If say there is a 45% probability of gaining 15%, 40% probability of getting a return on investment of 8%, and 15% probability of loss for about 11%. So to calculate the expected return, 45% probability multiplied to 15% plus 40% probability multiplied to 8% plus 15% of probability multiplied for the 11% of loss, which will give you an 8.30% of expected return. In this given scenario, the calculated expected return is 8.30%, which is higher than the return goal of the client. In that case, the client is considering pushing through with the investment. But in case the calculated return is lower than his return goal, he will consider if he will still go through or stop the investment.
Since our client Mr. Hector Calma is identified as a moderate investor who values reducing risks and enhancing returns equally and is willing to accept modest risks to seek higher long-term returns, taking that into account after a careful consideration and given the current condition of our investment market amidst pandemic, the specific investment we advise him to invest in are both in stocks and bonds as well as in real estate. First in stocks because in today's time, many investors have tended to pull out their money from the stock markets, and with this reason, it enables people to buy these stocks at a lower price. As stated by the Bank of the Philippine Islands of 2019, global central banks will be cutting interest rates just as they did in the 2007 financial. And indeed, our client could make use of this opportunity as investing when the market was low can gain the most returns when it started to recover. The most important factor we consider is that in here, it can offer our client a stability in size and tenure as well as a steady dividend payout. Next is bonds. Investing in bonds are issued by the Philippine government through the Bureau of Treasury. Essentially, investing in treasury bills or certificate of deposit enables our client to get interest in advance and he can already enjoy high yields in short term also. This kind of investment can offer him a predictable return, interest options, securities, and such. Upon assessing, we found out that bonds like this tends to also be less volatile and risky, and when held to maturity, it can offer him a consistent and stable returns. That is why we chose it as one of his investments, as it is well suited on his character or investor type.
Real estate investing refers to the purchase of property as an investment to generate income rather than using it as a primary residence. When investing in real estate, the goal is to put money to work today and allow it to increase so that you have more money in the future. It is common for investors to own multiple pieces of real estate, one of which serves as a primary residence, while the other are used to generate rental incomes and profit through price appreciation. In investing in real estate, you can have a steady cash flow, which means that you have enough rental properties going that you can generate a reliable revenue stream from your business. Long-term returns will usually be positive. Over time, most properties will appreciate in value in investment in real estate. It can create capital gains for investors due to the increase in property value as well provide rental income. Investment in real estate can provide opportunities for investment to build wealth, increase income, and diversify an investment portfolio.
This is the proposed diversified portfolio for our client, Mr. Hector Calma, which consists of 3 types of investment: stocks, bonds, and real estate. Fees matter, so you should be careful what you choose to pay, whether you go with active or passive management. Try to keep the total fees you are paying in your portfolio at or below 0.5%. That's half of 1%. For the detailed allocation of the investment for stocks, large cap stocks are stocks with market capitalization of at least 100 billion. Large cap stocks tend to be more stable than any other categories of stocks. Many of them also pay dividends, providing additional income to shareholders. Large caps are typically suited for investors looking for current income and capital preservation. Foreign developed equity, funds that invest in stocks from developed countries or markets outside the US. These include Germany, Japan, France, the UK, Australia, and others. Emerging market equity, funds that invest in stocks in emerging countries or markets outside the US. This includes Brazil, China, India, Mexico, the Philippines, Russia, South Africa, and many others. Small cap stocks are stocks with market capitalization of less than 40 billion. Small cap stocks are usually composed of companies with small numbers of shares outstanding or young companies with high potential for growth. If you're willing to take in more risk in exchange for a possible huge price appreciation, small cap stocks may be for you. Core bonds. Core bond funds typically provide investors with broad exposure to the investment grade area of the bond market through investments in a wide variety of market segments. High yield bond, a high paying bond with a lower credit rating than investment grade corporate bonds, treasury bonds, and municipal bonds. Because of the higher risk of default, these bonds pay a higher yield than investment grade bonds. Real return or TIPS. TIPS stands for Treasury Inflation Protected Securities, a treasury security that is indexed to inflation in order to protect investors from the negative effects of inflation, and another term is long-term bond. Last is real estate. REIT stands for Real Estate Investment Trust. It is a type of security that invests in real estate through property or mortgages and often trades on major exchanges like a stock. REITs provide investors with an extremely liquid stake in real estate.
Portfolio management entails managing a group of investment under an overall umbrella called a portfolio. A portfolio can be comprised of one or two different investment vehicles or a collection of various investments. This investment may be held in one account or in several. For example, is a retirement account and a taxable investment account. Portfolio management is a process of choosing the appropriate mix of investment to be held in the portfolio and the percentage allocation of those investments. Asset classes can be included of mix of stocks, bonds, and cash. This might be held in some combination of individual stock, bonds, or via mutual funds. Additionally, the portfolio may include alternative investments such as real estate, private equity, or precious metals. In managing the client's portfolio, you should measure its actual behavior in relation to expected performance. Diversification in portfolio can be seen since the client have a multiple investment such as in stocks, bonds, and real estate. Diversification is a practice of spreading your investment around so that your exposure to any one type of asset is limited. This practice is designed to help reduce the volatility of your portfolio over time. This also refers to having a mix of investments that are not highly correlated to one another. The reason for having an investment with a low correlation to other holding in portfolio is to try to ensure that the entire portfolio doesn't suffer a large loss whenever the stock market or a certain sector moves downward. One of the requirements to sustain the current asset allocation strategy is to rebalance it, or redo its allocation every now and then. Rebalancing the portfolio is very important because the market performs increase or decrease the asset's value in some investment with time. There are a lot of factors that could cause investment risk. The most popular is the volatility, where investment prices volatile to high and low levels without warning. This means that the price might go to less than the price the buyer paid to get it. The problem with volatility is that it cannot be predicted nor its effect on investment. In the current scenario where there is quality money in the market, portfolio management is needed, a preferred method of making investment. With the range of products available across different schemes, there are something to offer for every individual as per the different criterions defined. This is one of the highly researched, tracked, and appropriate method of investment giving exposure across the different options available.